Let's get to that market analysis now. My next guest says that although a deal on the debt ceiling could spark a relief rally, it will only be short-lived. Cliff Bennett from ACY Securities joins me now at the desk. Clifford, sorry,
Carl.
I called you Clifford now. I
know.
like
I nearly left, but yeah, no, I'll stay.
Yeah, good. Be patient with me, please. Just got your note this morning. Of course, we have had this sort of relief rally on maybe a number of factors, but the fact that we've seemingly pulled ourselves back from the precipice with this debt situation is a part of it.
Yes.
But you suggest that although this could lead to a short-term risk on move, you still think there's a bit of a crash coming?
I do. So I must admit, it's getting very tricky though. I mean, it's pretty obvious that people were cautious way ahead of the debt ceiling crisis, but then no one really believed it could happen except myself. But they're going to save the bell, perhaps at the last moment, but they could even default, but I wouldn't get too worried. If they default on the 5th, we all know they're back on the 6th or 7th in business. So I'm calling it a possible technical default, like we had a technical recession. Mm-hmm. But I do think most market participants, this is what concerns me, were expecting a solution and therefore saw a buying opportunity. And so it gets very convoluted here because we don't know if people are already long for this outcome, in which case it's a case of buy the rumors, sell the fact. The other thing is it doesn't change anything. In fact, it makes everything worse because it kicks the debt ceiling 2 years down the track and it's going to be a lot higher then, it's going to be a lot worse. It jumped from near 100% to near 130% now in just the last few years, and it continues to grow. So the US debt situation is really dire. There's no mincing words on that. It's not something for any country to be proud of, to be at 130% of GDP. In terms of its national debt and growing with no hope of turning it around, it would seem. So that's a rather negative outlook for the US as a nation and for its economy eventually. In the shorter term, we're seeing still benefits from those near zero rates for too long. Still a lot of money washing around the world, has to go somewhere. We're still seeing some of that, of course, stupendous extra spending by the government is finding its way into the market eventually as well. So there's just more and more liquidity. The Federal Reserve has raised rates aggressively, but current levels are still modest by historical standards. And a lot of people think this is an aberration, but the aberration was previously, and this is a return to normal. So rates will stay high, but they're not necessarily at a level that stops the equity market. So I think it's the other side of the coin, of course, is Main Street. The real world economy in the United States is falling apart, to be honest. I mean, manufacturing's had 7 straight months now being in contraction. The PMI came out yesterday, really low at 46.9. And I think, property prices are still falling. There's a lot wrong with the US economy at the moment. And unless you're on President Biden's sort of level, you should be aware that the US economy is not looking good. It's slowing very rapidly. It more than halved in GDP from Q4 to Q1, and it's probably going to have another downgrade for Q2, Q3. So a dire economic outlook, a banking crisis that's still more than simmering in the background. That's an ongoing disaster in terms of that new banking policy there about the big banks, 100% deposit guarantees. So the banking crisis is going to get worse. I wouldn't be surprised if 1,000 banks are gone by 12 months from now. In the GFC, 2,000 banks went under. So let's say there'll be several hundred banks going under over the next 12 to 18 months. But the hope for that is that the Fed is now recognizing it. Remember, they once hiked just after the second biggest bank failure in US history recently, but they seem to have changed their tune. Jerome Powell's certainly changed his tune, and I think he's looking to really respect the natural tightening that's coming out of this banking crisis, plus not making the banking crisis any worse. But of course, inflation stays high, so he won't be cutting rates, but there is more of a hope now that rates could be near a temporary plateau that could last 12 to 18 months. So, but what I kind of, that was a lot of ground covered very quickly, but what I draw it all down to is, on the one side, you still have tremendous liquidity in the system, and on the other side, you have a dire economic outlook for the United States. So if you're only looking at the fundamentals, you wouldn't be buying stocks. But if that liquidity is so excessive that it continues to push markets higher, then you're going to have further momentum trades to the upside as well. But I would caution this debt ceiling scenario could be a sort of a turning point where there's the pre-debt ceiling resolution market and the post-debt ceiling resolution market. And that post-debt resolution market is probably going to be about a lot of money managers around the world reconsidering taking a fresh look at the total fundamental economic outlook. We know China's not going to be a boom economy. It's going to be a strong but not boom economy. We know Europe still has significant troubles. So the world's three largest economies do have challenges, and the US does in particular. So fundamentally, after this relief rally on the debt ceiling, I would be a seller of stocks. In fact, I'm a little bit personally short a few indexes at the moment, just in case it falls away early, but I've got tight stops on that. So I'm really looking for what the market isn't expecting, which is that the debt ceiling rally can't be sustained. But I must admit, it's a contrarian view.
Yeah, indeed. Well, I wanted to play that game that we like to play sometimes when it comes into a central bank meeting, which is, what should they do versus what do you think they will do?
Right. Yep.
So Fed meets in 2 weeks. We've got a lot of data, so I guess the proverbial water to go under the bridge before we get there. But I'll put the question to you: Fed meeting, what will they do versus what do you think they should do?
Federal Reserve members tend to change their minds very slowly, and I think they've made a bit of an effort to change their mind towards a pause. So it will take a lot to move that needle back again. So I think we're probably going to have a pause at this next meeting. My previous forecast was that every second or third meeting till the end of the year there would be further rate hikes, because I have no doubt inflation will continue to surprise most people in how firm it remains in the United States, particularly, as we all know, in sectors and core. So with that said, there's no prospect at all, and I've said for the last 2 years, no prospect at all of a pivot or the Fed cutting rates, because inflation is simply too high. Even if it drops significantly, it's still too high for rate cuts. So, and I don't think it's going to drop significantly. It's going to be consolidating now on a plateau. So the Fed won't be able to cut rates. It will want to hike rates, whereas previously it was happy to hike rates against economic pain. It didn't, in fact, desired economic pain, it would seem. But I think when you overlay on that slowing economic outlook now, the fact that the banking crisis could, in the background, without us really being aware, could actually be getting worse, then I think the Fed could perhaps hold for 2 or 3 meetings.
Interesting. Okay. Well, a final question, and because I know you enjoy just as much as me observing the madness of crowds, I suppose financial markets provide us plenty of opportunities to observe it.
But there were 2 books. There was The Madness of Crowd and The Wisdom of Crowds.
Is that right?
Yeah.
Were they written by the same person? Just
No.
goes for it?
No.
Like
The
a Jekyll
Wisdom of
and Hyde
Crowds was
situation?
a psychologist who said that the crowd does tend to get it right. But anyway, sorry, The Madness of Crowds.
Madness of crowds is somewhere around, because I wanted to ask about AI, because it seems to be that at least this rally on Wall Street has been held up by a narrow set of stocks which have AI slapped on them in some way, shape or form. So, I mean, is this an example of irrational exuberance perhaps, or maybe is there some kind of justified and fundamental impetus?
Yes, I think there is a justification to repricing AI, potential AI leaders in the market, but has that repricing got a little bit ahead of itself? Probably it has. Yeah. Okay. But it is a bit of a worry for the broader market that's a very keen observation of yours, that it is a narrow group of stocks that are driving the indices higher at the moment.